You've probably heard people argue this before. Dividend stocks are the safe play. Growth stocks are how you get rich. Sounds simple, but it's also misleading. Because the truth is, either one can build serious wealth or quietly destroy your returns if you don't understand what you're doing. So instead of asking which one is better, the real question is, which one actually fits you? Today, we're breaking down dividend stocks and growth stocks in the simplest way possible. No jargon, no confusion. And by the end of this, you'll know exactly how to choose, or how to combine both and come out ahead. Ever wondered why some companies pay you just for holding their stock, while others refuse to give you a single cent? And more importantly, what's the hidden downside most dividend investors never notice? Let's get into it. Welcome to Money Mind Lab, where we make investing simple and practical. Quick note, this is not financial advice, just clear ideas to help you think smarter about money. Dividend stocks, getting paid to wait. Think of dividend stocks like owning a small piece of a business that sends you cash regularly. When a company earns profits, it can either reinvest that money or share part of it with shareholders. That shared portion is called a dividend. If a $100 stock pays you $4 a year, that's a 4% dividend yield. Simple. But smart investors don't stop there. They look at three important things. First, payout ratio. This shows how much of the company's profits are being paid out. Around 30% to 60% is generally healthy. Above 80% can be risky, because if a company is paying out too much, it may struggle to maintain that dividend in the future. Second, dividend growth. Some companies increase their dividends every single year. That means your income grows over time, even if you don't invest more. Third, consistency. Companies that have paid dividends for decades tend to be more stable and predictable.
The dividend trap. Most beginners miss this. A high dividend yield looks attractive, but sometimes it's actually a warning sign. If a stock price drops, the yield goes up. So that 7% yield might just be a struggling company in disguise. And if the company cuts its dividend, you lose income, and your stock value may drop too. That's a double hit. So remember, don't chase high dividends. Focus on strong businesses first. Growth stocks, building for the future. Now let's talk about growth stocks. These companies don't pay dividends because they're focused on expansion. They reinvest everything into new products, hiring, technology, and scaling their business. Instead of getting paid today, you're betting the company will be worth much more in the future. Your return comes from the stock price going up. How to evaluate growth stocks? Simple. Here's what actually matters. Revenue growth. Is the company consistently growing its sales? Profit potential. Even if it's not profitable now, is there a clear path to get there? Competitive advantage. Does the company have something difficult to copy? Valuation. Even great companies can be bad investments if you overpay. The hidden advantage. Taxes. Here's something most people overlook. Dividends can be taxed every year, which reduces how much you can reinvest. Growth stocks, on the other hand, are usually taxed only when you sell. That means your money compounds without interruption. Over long periods, this can make a huge difference. The big insight most people miss: dividend versus growth isn't really a battle. It's a timeline. Many companies start as growth companies, then later become dividend-paying companies. So instead of choosing one side, you can invest across different stages. A smarter strategy. Here are three simple ways to approach it. 1. Income strategy. Focus on dividends. Best if you want regular cash flow. 2. Growth strategy. Focus on high growth companies. Best for long-term wealth building. 3. Hybrid strategy. Combine both. Growth builds your wealth. Dividends add stability and income. One final thing. Reinvestment. If you spend your dividends, you get income. If you reinvest them, you unlock compounding. And compounding is where real wealth is built. So, what should you choose? Ask yourself, do I need income now or later? Can I handle market ups and downs? Am I investing for 5 years or 20 years? There's no one-size-fits-all answer, only what works for you. If this changed how you think about investing, hit the like button and subscribe for more simple breakdowns like this. And I'm curious, are you focused on dividends, growth, or both? Let me know in the comments. Thanks for watching, and I'll see you in the next video.